Perfect. So we are live, and this is the first class of our Pillar 2 study. The objective is that you guys will attempt the June 2026 Pillar 2 award exam, which is issued by CIOT. So whole of our preparation would be tackling the CIOT exam, okay, predominantly, and while doing so, we will understand Pillar 2 in immense depth. Now, please understand that this is the OECD regulation. We are not going into the UAE's regulation regarding the domestic minimum top-up tax. We will first look through what OECD has to offer, and it is immense. And once we write this exam, which is fundamentally based on the OECD principles, we will be much in a position to appreciate what Dubai or UAE, as a matter of fact, has done with their Pillar 2 law or their domestic top up tax law. So let's go very slow. We have 6 months for the exams. So we will go very, very slow and we will try to understand everything in detail. Meanwhile, what you guys have is keep on asking questions. See, we are stepping into international taxation, so it may not everything may not be very much clear and lucid once we prepare. And what happens is, I would be in the impression that you understood, and I will just move on. So never do that, because if you get stuck somewhere, or if something does not align or something does not make sense, please feel free to stop and clarify that so that we can move together. And how do you prompt me? You can use the chat, because I will be always the chat is kept open. So you, if you have any problems, just open the chat and type it out, and we will stop even if there is one chat notification that hits my inbox. Okay. So, with all these ground rules, let's understand pillar two. So today I thought we will just understand, why such a taxation is being imposed, and we will get in line with how to study and how to kind of go about this entire discussion. Now, if you see, what is pillar two? Or rather, you guys would know that it is a 15% top up tax, right? I mean, everybody knows that. But do you know why it was introduced? What are the reasons why such a tax is introduced? Understanding this is very important, because it would give you a leverage as to appreciate what solution this tax law brings as to the proposed solution. So you see, the problem with international taxation, from 2000, let's say late 2000s to the whole of 2010s, international taxation was dying. Trust me, this practice was dying majorly because of the global tax revolution. There were rules in place, but it was very easy to circumvent the rules. Now, if you see, for decades, the international tax system was built on a brick and mortar world. What does mean by brick and mortar world? It means, you have to be there physically to attract. I'll give you an example. Let's say the basic concept of permanent establishment. To have a permanent establishment, say you're from UAE, and if you need to have a permanent establishment in the other country, you should have a physical office or a physical setup. You should have employees there. You should have agents there. All these rules are there, but end of the day, it was emphasizing on physicality, because these laws were written way back. Okay, the first international transaction happened between Prussia and Austria, and that too back in 1757. And that is when they started writing the rules for international taxation also. So these basically needed, say, if basically what is meant by international taxation. Let's say that you are getting taxed by two countries. You're doing an international transaction, and correspondingly you are paying a tax for that. So in such a scenario, international taxation would hit, or an international transaction normally used to be physical. Somebody used to go from one country to the other country and do trade or business or whatsoever, and for that there used to be a tax. Now this is how the tax laws have been written as well. But what is happening currently is that we are doing digital. Now let's take the permanent establishment example and just think about it in such a way. Let's say that I don't have a branch or an office in another country, but what I'm doing is I'm having freelance agents. Okay, they just need a laptop, and they're using their personal laptop and working from their home. Do you think it would create a PE for me? Does the business have a fixed place of business, or like, does the company have a fixed place of business in the other country? Can I say that the employees who are working remotely in another country, at their home using their personal laptops, would create a permanent establishment for me in Dubai? Do you think so? Yes or no? I would appreciate if it is kind of like, put down in the chat box. See, my point is pretty simple. I'll repeat that. So let's say that let's say we as an office has an Indian division, correct? We have an office there. We have office chairs, furniture, phones, everything there, and employees come and work. Does it create a permanent establishment for this company in India? Yes or no? I have an outsourcing division. There are people sitting in India, and I have an office. Absolutely yes, because they have a physical presence in India. No, if you say, if you the building would be leased in my name, there would be a lot of sorts of things where I can say that I would have a physical presence. So somebody has to send me a letter. Let's go to the basic fact. Somebody has to send me a written correspondence, okay, a letter or a mail. They would have an address in India to where they can send it to, right? So that means I have a fixed place. Now look at what has happened after, like, this was like, what everybody used to do. But now, instead of having an office in India, instead of having an address, instead of paying truckloads of money on a lease, what I do is I hire some freelance agents. And what I tell them is, boss, let's say that, what I tell them is like, sorry for that interruption. Yes, okay. What I tell them is like, you work on your own laptop. You install the softwares, you buy whatever MS Excel you want, and I will pay for you that. You sit at your home and work. There is no office or concept. Such a model is workable these days, right? So what is happening is, because the international tax system was built for a brick or mortar world, right now the digitization is changing the way that we are doing business. I no longer need to have an office in another country. I no longer need to employ employees. I can do everything digital. I can get freelancers, and maybe I don't even need people sitting in India to do. I could go to a country which is even cheaper in terms of labor. For Indian operations can be run by a team which is sitting in Vietnam as well, where the labor is even cheaper. So it has become very difficult to apply the international tax principles. And of course, on top of that, what is happening is, this, in a, like, globalized economy, profits are becoming homeless, or it is being migrated to low tax jurisdiction. Now, what do you mean by homelessness? Did you understand the first one, why international tax system was built on brick and mortar world? And right now, digitization is changing the way in which we apply those things. Right. In the second example, do you think that I would have a permanent establishment? Do I have an office, or do I have any physical presence where somebody could write a letter to me and it would get delivered? No. I can't say that my employee's home is my presence. No, that is their home. Right. So I can circumvent the PE in all matters if I employ digitization to a greater scale. That is what is point one. Did you understand point one? I can work without a physical presence in any other country. Yes or no? Okay. Now, what is point number two? In a digital globalized economy, profits are becoming homeless or migrated to low tax jurisdictions. Now, to understand that, what is meant by homeless in an international tax perspective? You see, there are entities which are homeless. That means it is not a resident of a particular country. Okay. So what happens is, let's say that, what is the basic framework of international taxation? There used to be a resident country, there would be a source country, right? Say we as a company are doing some business in India. Which is the resident country? Where is the resident country? Let's say we today are doing a business with in India. We are providing some legal report, or we are just analyzing some legal pronouncement for them. So I'm doing an international transaction, right? For an Indian client, I'm doing some business. Now you tell me, what is, in this particular transaction, in international tax framework, which is the source country and which is the resident country? Yes. A company in UAE is doing some business with a company in India, and international tax is applicable for them. Obviously, it's an international transaction. Company in UAE is providing some services to Indian company. In this context, to apply the DTA between India and UAE, which is the resident country and which is the source country? Okay. So, in this context, resident means where I am a tax resident of. So, if I am a company that is incorporated in UAE, where do you think I would be a tax resident of? Absolutely. So I would be a resident of UAE and India would be my source country because I am deriving my income from India. So that is the source of my income. That is why the other country is called a source country. Okay. So international tax framework, you have to always see who's the resident country, which is the resident country, and which is the source country for each taxpayer. Okay. Or basically, like whoever derives an income, you have to see which is his resident country and source country. Now, primarily, if you look at OECD principles, the taxation would be more favored on the resident country. Okay, now in the setup, like we doing some service and UAE being the resident country and India being the source country. Now there is some income that the UAE entity is getting from India, right? Now, who should tax that income? Should India tax that income or should UAE tax that income? That is the basic question that we are solving with tax treaties. Why should India tax it? Because India would say, so you are doing something from India, like since we are having so much of need, demand, market, consumers. That is why you are able to come to our market and source this income. So that means since we are a market economy, we should be taxing you. But UAE would say, boss, you are incorporated here. Even though this transaction involved tampering into Indian markets, you are a company which is incorporated here, and we provide you the infrastructure to do. The employees are from here, everything. So that means the resident should tax. So this is a conflict which goes. This is what is solved by the treaties, which is just an agreement which is signed by the two countries. Like who should tax in case of a particular income. And in most of the OECD frameworks, what happens is it is tilted towards the resident side. Okay, if you take any model of the OECD convention models, it would be more into the resident side. But there are, problems also. Let's say that Apple is selling in India. If all the taxes are going to US, obviously India would kind of reject, right? So there are UN models also which is tilting the taxes more to the source jurisdiction. But let's leave UN model for now. Let's focus on OECD model. So OECD models, what happens is the taxation is more tilted to the resident side. Now, if I tell you, if I have a company which is doing so much of profits and it does not have a residency in a particular country, that is what is called as homeless, companies or homeless taxpayers. Okay. So if you don't have a resident country at all, then nobody is taxing you at all. This is, I will take one of the case studies which was done by, a tech company. Okay, I will not tell you which is the tech company, but you can figure it out. I can just provide you a little bit of, like, this is what they look like. And the forbidden fruit of Eden. You can take reference as to which global company that is. And now what they did in terms of, like, becoming homeless, they tapped into homelessness. So what you have to understand is this global company, it is a global giant. It makes profits like crazy. And can you understand, by tapping into this homelessness status, they pay an effective ETR of 1%. Now, okay, this was around in 2014, it was around 0.005%. Their total effective tax rate. That is crazy. And look at the scale of it. Of their total income, this is what they're paying in taxes. Obviously, their stock prices will go up, right? Obviously, their investors would be very happy. And on top of that, it is giving a lot of, it is not a level playing field. Say we start a similar tech company, we will be paying so much of taxes. We cannot compete that. They're saving a lot of taxes. Now, the global question is, how did they solve this taxes? What is this homelessness state? So obviously, you know that these companies are incorporated in the Silicon Valley, correct? What they did in this particular case of this guy, what they did is they started a subsidiary of this US company in Ireland. Okay. And they call, let's for our discussions, call it the head office. It's a subsidiary of the old main company. And there is absolutely no substance. There is no employee, no nothing, no absolute. It's a paper company or a shell or a blast brass plate company. That's it. Okay. What and then what they did is they incorporated a branch of the main entity, and we can call it as a branch office. And branch office has a lot of substance. Okay, they have employees, they have tech, they have everything. All the operations are run from the branch. The subsidiary or the head office in our discussion is just a decoy. Now, what is happening is, let's say that this branch does all the uh, work, or all the services. Like, if you want to purchase something from the cloud, or you want to purchase something, etc. All things are managed by this branch. Okay, so if a customer from EU, Middle East or India just pays $100 to this branch office, what they what was happening is, Ireland's were okay, because they are doing a lot of operations and there is an office here which is having a so much of substance, so they think that okay, it is not some tax evasion. But inside, what was happening is, this subsidiary was taking the whole amount as royalty. They'll just keep $1. Okay, they will keep 99, they'll take 99% of the money from this branch as royalty. Okay, and what happens is they have going to a homeless state. Now, in this example, to understand homeless state, how did they achieve homeless state? Why do you think that Ireland is not taxing them? What is meant by homeless state? For this, it's not rocket science. It's pretty simple. What they do is, this company, what they do is, let's say they are a subsidiary of US, right? In US, what do they fill is, we are incorporated in Ireland and hence we are a resident of Ireland. This is the statement that they use in the US filing return. In the Irish filing return, they would say that no, 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 even though we are incorporated here, our POEM is USA. So this country will think that okay, it's a resident of Ireland. This country will think that it's a resident of US using POEM. So basically, in the filings that we do, it goes into a homeless state. Okay, when we apply a treaty, it neither becomes a resident of Ireland, neither becomes a resident of US. So this is what, no, it was possible back then. This, by this, they were cutting a lot of profits. Now we can take you through one more example. Okay, this was a tax saving mechanism which was existing for a long time. It's called a double Irish Dutch sandwich. What does it mean is, this particular logo, the owners of it were using so much of so much of this to save a lot of money. But more of that later. But what I need to understand is, what they're doing is, let's say that they incorporate a company in Bermuda. Now, what is the significance of a company in Bermuda? There is no corporate tax. Okay, Now, this company and this company would start. They would also start a company in Ireland. Let's call it the company one. Okay, and this company's tax residency is Bermuda. Okay, on basis of poem. So all the employees and all the decision making were done from Bermuda, and this is one company which they would start. They would have a Dutch company. They will then incorporate a Dutch company and then a second Irish company. So that is why it's called double Irish Dutch sandwich. There are two Irish companies, and in between that, a Dutch company is sandwiched. Now, let's say a customer pays $100 to Irish company two. Irish company two is a resident of Ireland. Okay. When they pay $100 to Irish company two, sorry, then Dutch company will take 99 as royalty. A lion share of that will go as royalty to the Dutch company. Now, and then from the Dutch company, a lion share of that again will come into the Irish company. Okay, so this is how they were like swindling profits. Now, what is the significance of all this? I, as a normal one person could say that why doesn't the Irish company pay to this Irish company instead of going through this, right? Because what you have to understand is since this poem is in Bermuda, okay, if I make a transfer, then this this you they have to collect withholding tax. Okay, even though this company is in Ireland, if Irish company two sends this money directly to Irish company one, there would be withholding tax involved because this is not a resident of Ireland, rather, it would be a resident of Bermuda. Now, if I put a Dutch company in between, the Dutch DTA states that if you transfer, this EU, the European Union has an agreement which says that if I transfer money to another member of European Union, there won't be any withholding. Okay, so to circumvent that, what they did is they transferred to a Dutch company. Now there won't be any withholding in it. Both are EU members, right? Now Dutch company, what they do is Dutch law specifies that it does not speaks about residency, rather it speaks about incorporation. So Dutch domestic law says that a company which is incorporated in EU, if I'm making any payments, then there won't be any withholding. Okay. So instead of residency, Dutch uses the word. So to that was a major loophole by which they were utilizing this. So if the Dutch company pays to the Irish company, there won't be any withholding. No tax at all. 100% goes into the Irish company. And where is this Irish company is taxed? In Bermuda, which at 0%. So end of the day, this income that they earn through this maze of three companies is taxed in Bermuda at 0%. Did you understand the double Irish Dutch sandwich what they used? They can't send this directly because Irish laws goes by residency, but Dutch laws goes by incorporation. So they use this loophole and kind of siphoning of money. Was that understandable? Yes or no? So, since there are all these things moving around and all these planning which is moving around, it reached a boiling point. So, again, if I transfer, or basically it means there won't be any transfer, but this would be taxed at 0%. So, you see, so being a homeless or, migrating into low tax jurisdictions, I could save a truckload of taxes, right? This was happening very rampantly. Like, the international tax was not able to mitigate these tax lapses. And another problem, which was also very rampant, was what we call as the race to bottom. Now, what is this race to bottom? It is purely political. It has nothing to do with tax. Now, what happens is, countries wanted FDI, right? Foreign direct investment. So, to gather foreign direct investment, what I do is I lower corporate tax. So, if you look at the history or if you look at the statistics, you will see that the global average corporate tax rate was 40% in 1980s and it has come down to nearly 20%. So that is why it's called a race to bottom. Everybody is reducing their corporate tax rates to bring in more FDI. You can see everybody is doing it. US is doing it. India has been doing it. India kind of cut their corporate tax rate to a large extent. So every so that investments don't go to China, rather it comes to India as a regional power. So cutting the taxes has been an easy fix politically to bring in FDI. That is one problem. And of course, what create again this global tax revolution and siphoning of money, as well as this tax competition and race to the bottom. What did it create? It world realized that what they were doing were wrong, and this realization came in during COVID, because during COVID our infrastructure and healthcare were really affected. Okay, it that is when especially the health infrastructure was affected, and countries didn't have money to kind of treat their their citizens. So when something like a pandemic comes, a pandemic meaning like it'll hit everybody at one time, the healthcare systems are not developed to bring in, or at least you don't need to develop 2000 hospitals or 100,000 hospitals for a pandemic. No, but at least if you could have staff for like additional beds or additional things which could be like wrapped about. If I have a school, instead of like carry the hospital to the school, keep a bed there. There was no money to do all that. There was absolutely no money. That is when the world woke up and said that because of all these things, like the tax competition as well as like global tax planning, which is done, we are not having money to serve the basic people. So it becomes a complete rhetoric in terms of rich becoming richer and poor becoming poorer, right? The poor didn't have money. I mean, government was not supporting the poor in term in when there was a pandemic. Rich were getting richer because why? Whatever the forbidden fruit company or the other company, they were making money because they are paying no taxes at all. But a common man like you and I, we are paying so much of taxes, right? And whatever system we get is nothing. So there was a fundamental problem with this. And of course, if I'm a small local businessman, I have to pay 35-40%, and I can't just get 0.005% as my tax rate. So this was a clearly a problem. This Everybody started recognizing this, identifying this, and starting measures to correct this after COVID. So that is why, to solve this problem, so that people don't kind of siphon money using low tax jurisdictions, and also like to kind of curtail down race to the bottom, what they have brought in the they have brought in the pillar two taxation. Now what it kind of like basically creates is, wherever you are boss, if you have this company set up, wherever in the world you are, you pay 15% minimum tax each entity, right? Now if Irish company has to say their profit is what, one, because they receive 100 paying 99, one. Here it also zero point 0.5. Here it is 98.5. So that it is not siphoned off to others. They said each entity has to pay minimum 15% tax. And that too not 15% tax rate. Let's say that you're in India, it is thrown to 25% tax rate. That doesn't save you. You have to have an effective tax of 15% on each company, right? So all these siphoning off or using loopholes with respect to anything can be stopped, and the race to bottom can also be checked. If you say UAE, come invest here, it's only 9% tax, right? But end of the day, for certain MNEs, there would be 15%, and that's not a UAE law. That's kind of a global thing, right? So anywhere you go, 140 plus countries have signed on this agreement. So that means that anywhere you go, you would have this 15% tax. So that would solve the problem of we losing money, and all these tech giants or like whoever it is, like big international companies saving money on taxes. That is why this came into being. Is it understandable why we have such a system, and what was the need for having a pillar two tax? Okay, then tell me why it is called pillar two. It is called pillar two because these were the problems which were affecting it, and to bring a solution to this problem, it was a two pillar solution that was proposed by OECD. Pillar one being sharing the digitization tax. Okay, it is not finalized yet, so that is a little rare. So what they're telling is they would give appropriations to the market economy as well. For example, let's say Facebook. Okay, Facebook is earning most of its money from consumers who are Indians. End of the day, Facebook is sitting in Silicon Valley, right? But who are driving its revenue? How is it getting its revenue? It's from ads, right? Ads which is played. And who are seeing it? Majority of the countries which have a lot of population, because people equal to more revenue line. So pillar one is a setup where which we can share. Globally there is a sharing mechanism where US will share money of the tax revenue with the market economies as well. It's not US. Like, basically speaking, the companies have to file in market economies as well a return where they allocate the taxes to their income there as well. So this was quite ambitious, like but pillar one, the basic problem is, let's take a basic framework like something else, like let's say ChatGPT. How would ChatGPT know from which country somebody is asking what? It is very difficult. So let's say that I have a revenue of, like, say, 100. How do I split? How many countries? How many people are? You have to break it using the tax residency of the countries. So let's say I may be a tax resident of India on a holiday in UAE, and I would be using ChatGPT. Now, how would ChatGPT know that I am a resident of India who's using it? You should not apportion to UAE, but rather you have to go to India. It's very difficult. It's very ambitious, and it has a lot of problems inherently. So pillar one is kept on hold. Okay. But pillar two is quite simple. It's quite flexible. It just says 15% every day, right? So that is why pillar two is something which is seen as an effective fix to this problem. Now, how do you study this? Now, basically, you have to understand that what we would be doing is the globe model. Okay. So you can find all these study materials. This would be your study materials which you have to use, and these study materials you can find uh, here. So let's say that you have to. Let's just type webs filler tool, and yes, what you see here, no, all the materials are available. You don't need to pay any money for it. So you come to this page and you will see everything here. Okay, so this is the model rules. So this would be what the rules will look like. Okay, it's kind of a 70-page document. But to interpret the rules, we need to look at the commentary also. So commentary is quite huge. Okay, so this is a commentary. It's about 374 pages of commentary. Commentary. What is commentary? Is like, let's say that law would only provide a certain framework, but commentary enhances it. Like, it shows us how to apply that in each and every framework. You will understand that. Okay, and there are a lot of materials which is published already. So this is the old version of the commentary. It's 23, and you can take the 25 version. Then there are administrative guidance. Basically means it is a guidance to the governments, like, as to how to include it. Let's not go there. But there are, like, a lot of materials which is there, like, how does the return look like, the globe information return, GIR. So all this is there. So if you see, just like how we have a tax return filing guide, they have also given how a guide to file the GIR. Okay. So all the materials and things are already there, already very much well done by them. So you can just use this as your study material. But how you should do is, like, these two are the fundamental things: globe model rules and commentary. Okay, model rules are how the law would look like. Say, for example, let's say article 18 shows about free zone. It is like half a page, or like, quarter of a page in the law. That would be what have the model rules. But to understand article 18 in full and what is substance and what is not, we have to look at the guide, which is around 100 200 pages old. So that is what is commented. So just to give you a very crude example of how to understand the whole thing. You will not learn anything by just reading Article 18. Rather, you have to dabble into the guide, and you have to look into everything to understand how efficiently you can apply this. Okay, we will be doing everything. So what I have done in the study or the PPT is that I have not just restricted here, but whatever is here, I've looked into all the others and provided you a concise. Okay, so that it's easy to learn from here, and going home, you whatever is taught and whatever is needed, we can. So again, just to highlight one more thing, if I look at the globe model rules. Yeah. Yes. So see, this is what it is. So first is all about scope. They have given, like, who is in scope, then what are the charging provision, then what is the computation of global income and loss. So they have actually segregated it into important subheadings and given it. So how we would be tackling this class is like we would be taking scope. We see, if you see, scope is just page numbers 8 and 9 in the whole of this guide, right? That means 2 pages. But if you see the commentary, it has a lot more to offer. So what we will do is we will read one a day. Okay, let's not go very fast. We have so much of time, and we will go one a day. And our aim would be to go through one let's say scope or one big one in 1 week. So if you can, we can do one subheading a week and one article a day. That would be more than enough, like, that is what we are planning to, so that we have so much of time to go home and refer and come back. Okay, so let's say that this week we started, this is Monday. By the end of the week, we would be doing scope. And not just that, not just understanding all this, we'll be doing a lot of problems as well. So we are only making a lot of problems. There is no guide reference to it, but we can try and dabble and do some problems as well. So today we will do scope. Tomorrow we'll do, like, so that's just how we will go. So you have a structure of where we are and what we have to reach before June. Okay, is that clear? How the class structure will go? Perfect. So as you see, the first thing is scope, and Article 1.1 is scope of globe rules. Let's try to dabble it today so that we come into the motion. Okay, perfect. And meanwhile, if you have any questions, like, anything which you don't understand, please let me know, because, right? So we will be looking at scope. Okay, this is first thing. So who would come into scope? That is what basically they're doing. So there are 4 chapters. We'll go to the first chapter today, which is revenue threshold assessment. Now, what does it mean? Now, after completing this chapter or the first part, you would be able to determine whether an M&E group meets the consolidated revenue threshold and document this assessment for compliance purposes. We have also given a line where, like, tomorrow when we are applying all this, when we are doing globe returns, what all documents you need. Okay, I have included that too in the PPT so that it's an easy referral. Okay, but it's a no-brainer. You can appreciate it here. Okay, so you tell me, when would a company be in scope of a of pillar? Yes. What is the revenue threshold? What is the revenue threshold? It's pretty simple. If an MLE falls within the scope of globe rules, all this 15% tax applies to them. If the consolidated revenue equals or exceeds 750 million euros in at least 2 of the 4 fiscal years immediately preceding the tested fiscal year. This is what is the article. But to apply that, we have to do a little bit more groundwork. Did you understand? So, if you have to come into the scope of Pillar 2 for the last 4 years, right? In the last 4 years, I have to be earning a total revenue of more than 750 million in 2 out of 4 years. Getting it? Yes or no? So, most basic thing that we could kind of, like, right? Okay, fantastic. Now, this is what is there in the main model model rule. But let's see dabble into the comment. Okay, you tell me why 750 million euros. We'll understand everything line by line. So why 750 million euros? Why can't they take any other amount, something lesser even, so that more companies would fall into the scope? Why 750 million? Yes. Why 750 million? Just give your reasons, guys. Why 750 million is because some people have already defined in their domestic law what are large taxpayers, right? And what is the threshold given in the UAE law? 3.15 billion, which would loosely, roughly translate to 750 billion. There is also one more thing. For transfer pricing purposes, there was another law which UAE had implemented in 2021. It's called the country by country reporting. Like everybody, like, if you are having a revenue of more than 750 million, right? That is when you have to file the CBCR return. And who files the CBCR return? Who files the CBCR return? The ultimate parent entity files the CBCR return. In some cases, in some countries, even the constituent entities have to sign. So, and this law, this started way back, right? As a matter of BEPS Action Plan 13, I believe. CBCR started way long back. So they have documents, my dear. Even if you falsify this now and say that, no, 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 I didn't go with 750 million, I have plenty of records from your CBCR filings to spot whether you were there or not, right? And CBCR is applicable when you're 750 to keep the same level of compliance. Okay, because you already are, for CBCR, you already invested money on filing a CBCR return. So adding this globe return, the data can be captured, your data capturing system would already be there, and you would not to invest more compliance onto getting more data, because CBCR already takes care of it, right? Yes or no? So they have given the same threshold as CBCR. There is no other manner to match with CBCR requirements introduced as per BEPS action. So CBCR guys, they would actually be have to filing a country by country report. So now using that, you can find the globe taxes also, right? So to match, so that it does not bring in additional compliance problems for others, they have kept it at 0 point. Now you tell me why 2 out of 4 years. What is the rationale that I have to earn you your 750 million? This particular thing is not there in CBCR. Mind me, CBCR is looking at the last year. You would be writing that in note 2 of your notes, right? If you at least read one of them, you would see that it's for the immediate previous year. If it is more than 750 million, why did they do 2 out of 4 years for Globe? Why? That is because, see, if it was for every year like CBCR, there would be, like, people going in and coming out, and so they don't want that. They don't want to people oscillating in and out due to single year fluctuations. Okay, sometimes, like, during COVID, the sales of all the masks and PP kits were at a very big level. Now, do you think that the companies would be earning the same revenue as they did in 2020, 2021? Absolutely not. So bringing in 2 out of 4 years would kind of take away all these cyclic, one-off transactions or currency movements problems. Okay, if you are having more than 15 2 out of 4, that means you are a big event. You are not there by just chance or luck, or, like, like an yearly cyclic movement. You are, boss. You would be taxed. Okay. Now let's understand how we should identify. Is it clear? What is the law? You have to be more than 750 million in 2 out of 4 years. Why 750 million and why 2 out of 4 years is what the explanation was. Now, how do you recognize the revenue? Now, what is the revenue that you use for SBR for getting 3 million? What is the revenue? What revenue do you use? I don't want to somebody to say 3 million. I want to say what does it mean? Is it total income or only the net revenue or only the things? So here when I say 750 million euros, what would I mean? What revenue? Total revenue or like which is kind of like the total of all the incomings that I have in my P&L, or it is just the revenue as per IFRS 15? What would be the in for pillar 2? Yes, for pillar 2, you don't need to go with the total gross. You only need to go at the revenue line. Okay. So how do you kind of find this revenue line? So if you are using IFRS as a consolidation mechanism, then you have to look at what is the revenue captured as per IFRS 15. Since we did IFRS before, I have the privilege to, I mean, I have the liberty to tell you, like, all the other income which is earned from other standards, ignore. Getting it? To find whether you come into 750 million or not. That's what we are talking about. So to find whether you come into 750 million for the last 4 years, only take the revenue that is calculated as per IFRS 15. Any income calculated using any other standard. For example, let's say you have an interest income. What standard would you use to calculate it? IFRS 9. Don't take it. Yes or no? Only revenue which you can take as per IFRS 15 should be used to estimate whether you're having 750 million or not. Okay, and when you go to the US gap, let's say that the global M&E is preparing using local US gap, then you have to take net sales or total revenue, as the case may be. This is the line item that you have to pick. You can't pick the total revenue as in like all incomings as you do in UAE corporate tax. Yes or okay? So if you see, what you should include, you should include sale of goods. Basically speaking, IFRS 15 applies. Sale of goods and services, royalty income. If royalty is your revenue, not as side income, interest and dividend if presented as revenue. That means sometimes banks etc. would have interest and dividend income as their main revenue. Then you have to take it. Okay, if it's your sub revenue, don't take it. And other operating income if it is in the revenue line. So just look at like you have to look at IFRS 15. Okay, for simplicity's sake, don't try take anything else. So if you have a doubt as to like, okay, this revenue item should be taken or not, just look at by which standard it has been computed. If it is computed using a standard other than IFRS 15, ignore for the purpose of determining whether you will come into the revenue threshold or not. Clear? Okay, what are the things you should exclude? Items below the revenue line, OCI items, consolidation, eliminations already reflected. So basically speaking, just take the revenue line. Getting it? Yes or no? Okay. Now, why are we doing this? To see, this is, we have to do this for 4 years prior to see whether you're coming at 750 million, you only take the revenue. Okay. Now, which financial statement to use? Say for the last 4 years, which financial statement would you use to pick the IFRS 15 amount? It's very easy to say it's 750 million, but see how the commentary is addressing what all problems could face. What financial statements would you pick this revenue line from? It's pretty simple. You would pick it from the audited, consolidated financial statements of the group. Okay, the one which is filed with regulators or prepared under statutory requirements. You should only take that. You should take the consolidated figure of last four. So you have to take as a group consolidated financial statements of the group, look at the IFRS 15 equivalent income and see whether you are in scope for pillar. Okay. Now, what about groups reporting under multiple accounting standards? For example, let's say that I have so many constituent entities which are using IFRS, but I myself is in US GAAP. So what do I do? And let's say audited consolidated financial statements, I'm doing one in local gap and one in IFRS also. So what do I do? Which one would I take? We have clients here who do one consolidated in basing in days and one consolidated using IFRS. So which consolidated to take now in this such a situation? These are real world problems which could arise, right? Which one could you use? So you have to use uh, from the primary consolidated financial statements you use for external reporting. So even if you're consolidating for GAAP or IFRS, which are you giving to the authorities? Which is used for external reporting? If you are a listed company, which numbers are getting which numbers are going to the stock market as a basis of your listing agreement? You have to take that and ignore the other one. Okay, what maybe one I'm just keeping it for my my figures, but what are you publishing externally? Which statement are you publishing externally? That would be used for finding the right. Now see, that is basically like when we look at the globe rules. See, one major loophole is we are trying to plug in people who are using tax treaties to save their income. But one thing that people say is since it is only IFRS 15 and you're using revenue, it's more linked to the accounting income, right? The basis becomes accounting income. So over reliance on financial statements would cause problems. Like I could dabble with it. I could reduce my revenue by going with so many things we learned in IFRS 15. Principal versus agent, sale with a right to return, consignment sales. Consignment sales basically I book only when the consigner sells it, right? Or consignee sells it, whatever. So this is the drawback. It is marked by the applicability is marked by accounting standards. And accounting standards is there is an over reliance on accounting standards. So if you have good IFRS people who can play with that, you can dabble and make sure you're out of the threshold by making sure you're reporting as per a accounting standard. Is it clear? We are talking about plugging things like multi the forbidden fruit company, and we kind of like plug all their international tax strategies. Boss, first fix your accounting. I mean, they could easily run away. They don't need to apply all this. They would just do a small fix on their accounting, use all these matters like principal or agent to reduce their revenue. They're out of scope, right? So this is the biggest drawback of global rules, that is over reliance on accounting figures. Now, what we are kind of talking about is we are looking at EUR, right? We'll say your total revenue should be more than 750 million euros, right? For to see whether you are in scope or not. Now you tell me, if I am making my consolidated books in any other currency, say USD or AED or INR, how would I convert it into AUR to check if I'm going over 750 million euros? For that, they said use the average exchange rate. And everywhere, like, I've also given where it is from so that it's easy for you to pick. Okay. So you have to use the average exchange rate to convert it into euro. And you should always use euro, even in your exams, to see whether they are meeting the threshold or not. You can't take a USD amount and do it. You have to crystallize, compact it using UR and do it. And where do you find what are the acceptable sources of exchange rates? You can look at European Central Bank annual rates, rates of Central Bank of reporting jurisdiction, or rate publishing groups audited. It's kind of on a hierarchy base. What exchange rates to use? For you should always use ECB's annual average exchange rates. Okay, ECB is European Central Bank. Now, if European Central Bank has no rate for your particular currency, let's say you are in some Kosovo or you are in some Kiribati island, and okay, whatever currency you use, I do not have an exchange. ECB does not have it. Then go to what your central bank is saying in terms of euro. And if your central bank also is not telling you a rate adjacent to euro, which is very rare, which will not happen, then you take a rate which is published in your group's financial. You understand that? So it is just like IFRS 13 where we use a level 1, level 2, level 3 comparison, right? So same like you have to go by the hierarchy thing. Okay. And of course, the formula is whatever is your revenue, which you pulled out, that revenue in the local currency into average EUR rate. Okay, fantastic. Now, you have to look for 4 years, right? As I told you. So, for just an example to make you understand, for if your financial year is ending on 31st December 25, which are the 4 years you will look like? You will look back. You will look back 24, 23, 22, and 21. Right? You will take the revenue figures of what revenue figures, consolidated revenue. You will convert it to EUR using average rates, and then see whether you out of 4 years are going above 750 million. You getting it? Yeah. And if it is financial year ending 30th June, then you have to look at if we are ending June 25, because 26 is what we are comparing for. So you look at June 25, June 24, 23, 20, right? Immediately preceding 4 years. And if it is 31st March, you have to look at 24 March. Same link. No doubt in this, right? The look back period, look at 4 immediately. Now, what if you have less than 4 years of history? The group was formed last year. What would you do? How would you come into whether you will come into scope or not? Very plausible question at the time of application, right? What would you do? Now, the commentary says if the group existed for fewer than 4 fiscal years, the test applies to years that exist. That means if you have 3 years of history, only 3 years of history. That means I am in my fourth year. I have 3 years before me. I have to make sure the threshold at least 2 out of 3 years. If I have only 2 years of history, I have to meet 2 out of 2 years. And if I only 1 year of history, so that means it's very difficult for new people to kind of come into school. Getting it? You have to look at whatever is your history and see whether you're in scope. If you are just having 1 year of history, you have to look at last year, and if it is more than 750 million euros, boss, you are applicable. You can't do anything more. Okay, fantastic. Now, what about newly formed groups with mergers? Say, for example, I was a group, so I was Apple, okay, and I merged with Samsung. Now I become a big group, right? And I did that this year. How will I look at the 4 years preceding and see what is my revenue now? Are you understanding the example? I am a group. I merged with another group this year in 2026. I don't have any history, zero history. Here we were talking about at least 1 year of history, right? So let's say that I have 0 years of history. What would I do? So you have to look at the for newly formed groups or mergers of big groups elsewhere, you have to look at the combined historical revenues of the predecessor groups as they've been consolidated throughout the lookout period. So you have to take both, groups and their total revenue for the last 4 years and understand if you are in scope or not. Okay, say I am a newly formed group, and to check if I come in scope of this pillar 2, I have to look at the two groups which merged, right? We have to look at total their revenue for the last 4 years. And if it is going above 750 million, then yes. Yes or no? Are you understanding? Okay. So this is a deliberate anti-avoidance design, because if people combine, then it becomes very easy. Okay. Now let's do a simple case study. Let's say that AR Group PLC is a UK headquartered technology company with 31st December year. The group CFO needs to determine whether AR is in scope of Pillar 2 for financial year 2025. They have extracted this information. Can you tell me, looking at this data, can you tell me whether AR Group PLC would be subjected to Pillar 2 in financial year 2025? Okay, there are questions that say yes. So let's look at how do we look at it? How do we see if they are So you look at what is your revenue. My revenue is in GBP, right? I will first convert it into EUR. so that I get the 750 million threshold. And so for the last 4 years, my revenue has been 727, 797, 856, and 938. So is it more than 750 million? Yes, in 3 out of 4 instances. So would that mean I would be in scope for pillar 2 or not? Absolutely yes. Okay. This is how you have to see. Now I would add a little bit twist into the matter. What if I was a merge group? I merged recently. I do not have all these figures. Then I have to look at what two groups merged. I have to take the figures of them for the last 4 years and kind of understand. Okay. Now there are like specific events which would kind of damper your things as well. Now let's say that there are acquisitions using during the look back period. That means it is not two groups merging. Rather, the group just acquired a new company. Okay. So now I acquired this new company. We are looking for 2025, whether they're applicable, and I acquired this in 2024 or 2025 rather. So I did an acquisition. A new company was acquired mid of the year. Should I kind of include that? When a entity is acquired mid-year, include its revenue from acquisition date only. Do not annualize or gross up the partial year. No. I'll give you an example. Let's say that we are doing it for 2025. Okay. I acquired a new company, a new constituent entity, not a group. I acquired a new constituent entity in, let's say, 1st June 2025. Okay. This company was existent. I just took over its shares now. Now, what revenue of it would you look back of this particular company? Would you look back for 2025 full year? Or would you look back only like, part of the year? Take the revenue only from the date of acquisition. Do you need a more example to that? Do you need a little push? Now let's see. So what I am trying to say is, let's say that there is this company, okay, XYZ group. Okay, it has around 20 there are a lot of companies there. Okay, it has already has three companies, three subsidiaries. Yes. Okay, this is subsidiary one, this is subsidiary two, and this is subsidiary three. Okay, this was existing. So we have to find whether XYZ group would be coming into the ambit of pillar 2 or not. What would I do? I will take the consolidated revenue of the last 4 years to check it. Correct? That part is clear. Now, let's say that I incorporated another company. Okay, or I acquired another company. Let's give it the name company 4. Company 4 was acquired only from, let's say, 1st June 2025, or let's say 1st June 2024 is when I acquired this company. Okay. Now the I am doing the pillar 2 study for the year 2025, right? For that, I know you have to take 2024 figures, 2023 figures, sorry, 2022 figures, and 2021 figure, right? We have to look at the revenues of all these to see whether I'm coming. Now, my point is, the group acquired entity 4 only from 1/6 to 2024. That's when I came into the control of this group or this company. Now, For checking whether in 2025 I would be coming into pillar 2, do I have to take all the revenues of 4 also for all these years and calculate? You understand? I would definitely take the revenue of these because these were there with me for long. But this I kind of acquired only on 1624. So the law says you only take for this particular purpose of this company, okay, for pillar 2 on the consolidated scale, only take the revenue of this guy from 1st June 2024 through 31st December 2024. Only take this, only add this revenue from the date of acquisition, only add the revenue of this guy. These guys, revenue can be used for all 3 years. Getting it? I should only start considering an entity for scope analysis only after the date of its acquisition, not before that. So, in this current example, for 2021, I will use the revenues of 1 plus 2 plus 3, right? What is the consolidated revenue? In this year, I also will use 1 plus 2 plus 3, revenues of all three companies. 23 also, I will use 1 plus 2 plus 3. In 24, I will use 1 plus 2 plus 3 plus 0.5 into 4 because it was captured from the second. So let's make it this local. Okay. Did you understand what I was trying to say? Like, how to find the scope of revenue for newly joined companies. Perfect. So these are the things which they will test you. So you should include its revenue from acquisition date on. Do not annualize or gross up partial year revenue. So I would say that what I would say is, okay, this is my 6 month revenue. So I'm going to annualize this. So if it was my 6 month revenue, what would have been the revenue 24, 23, 22? Don't do all that nonsense. You just kind of like, take it from the date of acquisition. Okay. Fantastic. Now, what about disposals? What about disposals? Let's say that I instead of like acquiring, I disposed this in 1724. Okay, same logic. So include revenues till the date of disposal. So if you dispose during the year, doesn't mean it will be taken at all. What is the time at which you dispose? Till that, the revenue should be added to test whether you're coming into the scope or not. Okay. What about demerger? When a group splits, each resulting group is assessed based on its post demerger value. The look back period for the first post demerger year requires allocation of pre demerger revenue to each resulting group on a reasonable basis. If the group recognized reorganized group had existed through the look back period, it would have been its own. Now, what basically they are trying to say is, let's look at demerger situation. Okay. So what happens is, let's say that there is one big group. Okay. And let's say this is AQ group. So what AQ has done is, like, it was a big group. It existed for, let's say it was there from 2001 until 2024. In 2024, what happened is this group split. Okay. One big group split into, AQ group and RRT group. So this is what we call as a demerger, right? Now, in terms of such a situation, this one AQ group does not arise at all. Like, it's gone. There is no group like that. There is only AQ group and RRT group. Now you have to take the to for let's say for 2025 to find what is the revenue of AQ group and RRT group, whether it is going more than 750 million, what we have to do? We have to first kind of like, find out the group revenue. Okay, we have to find the group revenue of AQ before consolidation and then split it to RRT and AQ on a reasonable basis. The new AQ and new RRT on a reasonable basis of the previous years. What would be the previous years in this question? It would be from, since we are checking for 2025, we have to look at the look back period will be 2024, 23, 22, and 21. For this look back period, we have to, in case of a demerger, we have to reasonably allocate the revenue for few of the big one to both of them to check whether we are fine more than 750 million in 2 out of 4 years. Are you understanding all this? Hmm? So this is where, so if the question says there is a demerger, you have to be very careful. You have to allocate on a reasonable basis. The reasonable basis and all would be given, but you can't assume that this is a new company now and there is no need of pillar two because it doesn't have any history at all. No, it has history. You have to define the history from the bigger group and kind of put it in. So this is what happens. So you see what acquisitions, mergers, when it happens, what happens? We looked at mergers first, no? Newly formed group with mergers. In case of mergers, we have to look at what is the predecessor group's total. In case of a demerger, we have to look at the predecessor group and allocate it to two groups. Why allocation is because now we are two, not one. In the other side, it is addition. Here it is allocation. Okay. So that is how you have to calculate the revenue. And obviously, did you understand acquisitions during look back period, disposals during look back period, and demergers, how to take the revenue? Okay, you just go and read it once you just have to identify. And of course, to first thing is always revenue adjustment. Like, you have to see whether you are in scope. So, what are the statements that you should, what are the working files that we have to use as a very good tax team? You have to have what are the documents you would ask them. You have to look at audited consolidated financial statements for the last 4 years, right? Obviously we need that as a source of revenue figures. You have to have revenue extraction working. Okay, you have to make a working using which line item was used to calculate the 750 million, and if the line item, what is the reasonable reference we used, whether it is IFRS 15 or equivalent, you should only use that line item. So you have to make a revenue extraction working, exchange rate documentation. So for that you need ECB printouts or equivalent, conversion calculations, assessment conclusion memo, formally record why it is, and if there is any case if there is any other case like demerger or joining in or like mid-year acquisition, mid-year disposal or demerger, then what we have to do is you have to kind of like include all that in the assessment conclusion memo what you actually did, and you have to do an annual review record every year. You have to see whether 750 million is reaching or not, going by the two bottom line. So this is what is, and of course you have to retain all this documentation for 7 years. Okay, so that is at par with our tax procedures laws. So this is what is scope. Okay, so if I kind of reasonably look at the guide, this is the commentary. See, scope is only this much. It's only, this is what we learned all this way. So this one paragraph You see, using commentary, how much we kind of like, what all permutations, combinations could arise, what exchange rate, what about disjointed groups, what about demerger cases, what about merger cases, what about mid-year acquisitions. So many things could arise. And also like 750 million. Okay, okay, what 750 million? I mean, where do I pick that? In which financial statement? In which, which line item? All that is much. So don't just say, read this, because while reading this, you will not understand anything. Read the commentary for Article 1.1 as well. So now if you go to the commentary, you see commentary for Article 1.1, you are given everything. So if you go through that, the language is a little difficult. So till 1.1.2, this is what you have to read to understand what we discussed. So this is the way to learn this. Okay. But here I would be looking at, both of them, both commentary as well as the, the material would be used. But what you have to do is, now you can go home and read this so that you will get an understanding. So tomorrow we will do the second. So this is all about scope determination. If you have any suggestions as to how to kind of go about things, if this plan is solid and working, then so this is the scope of globe rules. Tomorrow we'll look at M&E group and how to find the constituent entities. Okay. What are the permutations, combinations there? Is it clear? Like, how do you determine the scope? Just go and read, because you need some, homework to be done for this to understand. But end of the day, it's not very tricky. If you understand why it is there and how it is going to help, then it is going to be fantastic. So if there are no questions, just send me no questions, NQ, and then we can wind up. Go read 1.1 today at home. It's a very easily manageable task. So let's cut it down into easy manageable tasks and go. Right. If it is all fine, then I'll just wind up. Let's focus on other things. Okay.